You're watching the price ticker and your heart's doing backflips. Silver just went from sky high to rock bottom, and now it's climbing again like nothing happened. And everybody's asking the same question. Is this the comeback, or are we about to get burned twice? Because what happened last week wasn't just a dip. It was a full-blown demolition that left traders staring at screens wondering if they just imagined the whole rally. But here's what nobody's saying out loud. The bounce you're seeing right now might be more dangerous than the crash itself. And if you don't understand why, the next move could wipe out more accounts than the first one did. It's early February and the metals market is acting like it forgot how to behave. Gold's pushing back toward levels that make headlines. Silver's moving so fast, you'd think someone hit the turbo button. And the crowd that got shaken out is now watching from the sidelines, trying to figure out if they should jump back in or stay away. But before you make that call, you need to see what's actually driving this rebound, because it's not what the surface level explanations are telling you. Look, if you're getting value from what we break down here on Element Axis, do me a favor and hit that subscribe button right now. It actually helps us keep producing these breakdowns, and honestly, the data shows most of you watching haven't subscribed yet, so if you want us to keep doing this, just tap it. It takes 2 seconds. Now let's get into what just happened, because the sequence matters more than the number on your screen. We had a monster rally that pulled in every type of player you can imagine. The serious long-term holders who stack for decades, the momentum crowd who chase whatever's moving, the leverage traders who want maximum action with minimum capital, and the weekend warriors who saw headlines and figured they'd get rich quick. When all those groups pile into the same trade at the same time, you don't need a crystal ball to know what's coming. You just need to understand how markets work when positioning gets this crowded. Then came the flush, 2 days of pure violence that erased gains so fast, people didn't even have time to process it. Silver posted one of its worst sessions in modern history. Gold had the kind of day that reminds you it's not immune to ugly price action. And the speed of the move mattered more than the distance, because speed is what triggers the machines. Stop losses get hit. Margin calls start flying. Risk management systems start dumping positions whether the fundamentals changed or not. That's not panic selling. In the traditional sense, that's forced liquidation. And forced liquidation doesn't care about your thesis or your conviction or how much research you did. It just cares about survival. What made this crash particularly brutal was the leverage component. See, silver doesn't trade in a vacuum. It trades in a system where margin requirements can change overnight when volatility spikes. And that's exactly what happened. The big futures exchange raised margin requirements right in the middle of the chaos. That sounds like boring administrative stuff until you realize what it actually means. It means traders who were perfectly fine at the old margin level suddenly had to come up with more cash immediately or get liquidated. And when you're in the middle of a free fall, you can't wire money fast enough. So positions get closed. And those forced closes push the price lower, which triggers more margin pressure, which forces more selling. That's not a conspiracy. That's just how the plumbing works. Now we're in the rebound phase, and this is where it gets interesting. Because a bounce after a historic flush can mean two completely different things. It can mean the market found real buyers, people with actual capital who see value and want exposure, industrial users who need the physical metal and are willing to lock in supply, long-term allocators who don't care about daily charts. Or it can mean you're watching a dead cat bounce driven by short covering and mean reversion before the next leg down starts. And the difference between those two scenarios is everything. So how do you tell which one you're in? You watch what doesn't lie. You watch the dollar because metals are priced in dollars, and when the dollar moves, it changes the game for international buyers. You watch real yields because they compete with non-yielding assets like precious metals. You watch how the market behaves during different trading sessions. Does it hold gains when Asia opens, or does it give them back? Does New York buying stick, or does it evaporate? You watch physical premiums in key regions because when paper prices and street prices start diverging, that tells you something about stress in the system. And you watch whether dips get bought aggressively or whether buyers hesitate. Right now, we're seeing strength across the complex. Silver's back in the 90s with moves that feel like somebody's flipping a switch. Gold pushed back above 5,000 after printing lows that shocked a lot of people. Platinum and palladium are joining the party. When everything turns green after a bloodbath, the natural human reaction is to relax, to assume the danger passed. But that's exactly when markets like to do something nasty. Because confidence comes back faster than stability. And when confidence rebuilds on shaky ground, the next shock hits harder. Let's talk about what actually lit the fuse for this rebound. You had a cocktail of catalysts, and if you only focus on one piece, you'll miss the whole picture. First, safe haven demand came roaring back. Geopolitical headlines started flashing again, and when the world gets nervous, capital looks for assets that aren't somebody else's liability. That's gold's traditional role, but silver rides along because it's cheaper per ounce and way more volatile, which attracts the adrenaline crowd. Second, the dollar softened. And you don't need an economics degree to understand why that matters. When the dollar backs off, the same ounce of metal looks cheaper to buyers using other currencies. So demand can spike, even if nothing physically changed about supply. Third, you had policy noise about building strategic stockpiles of critical minerals. That's not abstract theory. That's the government basically admitting supply chains are a national security concern. And even when silver isn't mentioned by name, the market starts thinking about what counts as critical for a modern economy. Electricity grids, defense systems, solar installations, data centers, electric vehicles. Silver touches all of it. Fourth, you had messaging from across the Pacific about currency ambitions and reserve status. Whether that's realistic in the short term or not, the market hears competition for monetary influence. And competition for monetary influence tends to push people toward hard assets. But here's where I'm going to push back on the simple narrative. This wasn't just natural supply and demand finding a new price. There's a structural issue in the metals market that keeps getting glossed over, and that issue is leverage. Silver didn't just fall because the sentiment shifted. It fell because the system forced people to sell, and forced selling is fundamentally different from someone choosing to take profit. When margin requirements go up in the middle of a violent move, traders get two choices. Wire in more cash immediately or cut the position. Most people can't get cash in fast enough, so they sell. And that selling pushes the price lower, which triggers more margin calls, which forces more selling. That's a feedback loop, and silver is the perfect setup for that kind of chaos because it's smaller than gold, it trades thinner in certain windows, and it's packed with participants who love leverage. This movie has played before. Different decade, different headlines, same human behavior. We saw it in the early 80s when rule changes collapsed silver. We saw it after the financial crisis when silver ripped and then margins tightened and the air came out fast. And we've watched smaller versions of the same pattern in recent years. Parabolic runs invite leverage, leverage invites forced selling, and forced selling rewrites the chart in minutes. So yes, the catalyst this time might look like geopolitics or central bank talk or policy headlines, but the mechanics that turn a shove into a landslide are almost always the same. Leverage, liquidity, and forced action. Now here's the part that makes this rebound significant. The crash didn't magically create new supply. It didn't add ounces to the ground. It didn't reduce industrial demand. It just reset positioning. And that's why the physical side matters. A positioning reset can clean out weak hands and cool off speculation. But if the underlying supply situation is tight, price tends to reassert itself. And the physical side has been tight for a long time. The silver market has been running deficits for years, total demand exceeding total supply over and over. And here's what makes that hard to fix. A huge chunk of silver production comes as a byproduct of mining other metals. So even if the price goes vertical, miners can't just double output overnight. It's not like turning up a dial. Plus, the demand stack isn't a single pillar. Solar build-out alone consumes well over 100 million ounces annually. Electric vehicles add tens of millions more. Grid upgrades and data centers pile on top of that. That's not investor psychology. That's industrial math. And the reason industrial math matters is because factories don't care if your chart looks overbought. They care if they can source material at a predictable price. That's the fundamental tension underneath this whole chart. A metal that the world keeps needing more of with supply that can't respond quickly, trading in a market structure that's addicted to leverage. So when people ask if we're going to see 100 by Friday, I hear a different question underneath. Is the market about to squeeze again, or is this rebound a fake out setting up the next trap? Let's walk through what actually happened in sequence, because the timeline tells the story. We had a parabolic move higher. Everybody suddenly had an opinion on precious metals, the get-rich-quick crowd, the doomsday preppers, the serious allocators, the momentum funds. When positioning gets that crowded, it doesn't take much to tip it over. Then we got the sharp 2-day drop that felt impossible to many traders. One day of carnage followed by another day of follow-through, and the speed mattered more than the size, because speed triggers systems. Volatility controls kick in, risk limits get hit. Machines start selling because they're programmed to survive, not to be right. After the washout came the rebound. Big, fast, aggressive. And that's where the story gets interesting, because a rebound like this can mean the market found real buyers, or it can be short covering before the next leg down. To tell the difference, you watch the drivers that don't care about feelings. You watch how price behaves when different regions open. You watch volume and open interest. You watch whether rallies are built on new buying or just covering. The character of the moves matters more than the headline percentage. And here's what makes me uneasy. The rebound is happening while all the same structural issues remain in place. Supply constraints, strategic stockpiling talk, big industrial demand, geopolitical uncertainty. Now the market has proof that margin policy can change quickly when volatility spikes. That memory changes behavior going forward. It makes rallies sharper and more violent because people either rush in early or refuse to use leverage. Either way, volatility increases. If you're finding this breakdown useful, drop a comment below and let me know what you're watching in the metals market right now. Are you buying this rebound or sitting on the sidelines? I read every comment, and the best ones usually spark ideas for future videos. And if this is helping you make sense of the chaos, share it with someone else who's trying to navigate this market, because that's how we grow this community. Now, before you think I'm here to tell you it's only up from here, let me give you the skeptical angle too, because you need both sides. The bear case is demand destruction. At very high prices, industries start looking for substitutes. They redesign products. They reduce usage per unit. Solar manufacturers have been actively trying to cut silver content per panel for years. When silver becomes a significant chunk of production cost instead of a rounding error, engineers get very creative. So yes, there's a world where the price surge accelerates substitution and slows future demand growth. That doesn't happen overnight, but it's real. And it's one reason I don't buy the idea that deficits guarantee straight line upside. Markets are messier than that. But here's the counter to that argument. Substitution takes time, and the demand stack is broader than one industry. Electric vehicles use more silver than traditional cars because of electronics and power management. Grid upgrades require silver. Data centers pull silver. Defense and aerospace applications pull silver. A lot of that demand isn't optional, so you're looking at a tug of war. Tight supply and strategic urgency on one side, substitution and volatility on the other, and in a tug of war, the rope doesn't move smoothly. It snaps back, it burns hands, people fall. That's silver. Let's talk about the retail angle, because it matters for price action and it matters for your decision making. During big moves, you get waves of new participants. Some buy physical, some buy ETFs, some buy options, some buy leveraged derivatives because they want maximum excitement. And when the move goes against them, they don't just lose money, they become forced sellers. We saw stories of people turning a decent gain into a disaster in hours because they were leveraged in futures or leveraged products. I'm not saying that to criticize anybody. I'm saying it because it's the recurring lesson in every metal mania. Leverage is a knife. It cuts both ways, and usually it cuts you. Here's something a lot of people miss: liquidity in the physical market. Because the paper price on your screen is not always the price you can actually transact at when the world is stressed. Local dealers and wholesalers can tighten up during extreme volatility. They may stop buying certain items. They may widen spreads. They may close early to reassess inventory risk. If you've never lived through a period where physical premiums go wild, you might not understand how quickly the retail market can disconnect from the quote. That's why you can't build a plan that assumes perfect liquidity at all times. The best plan is one that still works when the market gets messy. When volatility spikes, big bars can become harder to move for some sellers because the buyer pool shrinks. Smaller denominations can be easier to transact. Certain classic forms can trade differently because people know what they are and they're fractional and widely recognized. That doesn't mean only buy small. It means understand your exit options before you need them. During calm periods, most products are liquid enough. During chaos, liquidity becomes selective. Dealers manage risk by controlling inventory. So if you're building a position, build it with intention. Have a mix. Don't trap yourself in any single form that becomes hard to move when you need cash. The very fact that liquidity gets weird during spikes is part of what can push prices higher later. When retail demand surges and supply at the dealer level gets constrained, premiums jump. That feeds the narrative, which pulls in more buyers, which tightens the retail market further. It's like a crowd trying to squeeze through one door. That's why you see periods where people argue online about spot price versus what they can actually buy it for. Both can be true. The paper quote can be one thing while the street price is another, and that gap tells you something about stress in the system. Now let's address the Buy Friday hype specifically because it's everywhere. Could silver move $10 in a week? Absolutely. We just watched it do bigger swings than that. So the price target isn't the crazy part. The crazy part is thinking it'll happen smoothly. If silver goes for 100 quickly, it probably won't be a gentle climb. It'll be a shove, a squeeze, a headline. And then it could snap back just as fast. So if you're going to play that game, play it with your eyes open. And if you're not going to play it, don't let the hype make you feel like you're missing out. Missing out is better than being forced out at the worst possible moment. Here's the real cliffhanger. The next big move might not come from silver itself. It might come from outside. A jobs number that changes rate expectations, an inflation print, a geopolitical escalation, a policy announcement about minerals, tariffs, sanctions, a sudden shift in risk appetite if equities wobble. Silver is reactive. It's like a sensitive microphone picking up vibrations from everywhere. That means your silver chart is also a chart of global stress levels. And that's why you're seeing so much emotion right now. Emotion shows up when people don't have a framework. So let me give you a framework you can actually use. Step 1, decide your objective. Are you hedging against uncertainty? Are you trading for profit? Are you collecting for the long term? Are you speculating on a squeeze? Be brutally honest with yourself. Step 2. Match your instrument to your objective. Physical for long-term holdings and autonomy. ETFs for liquidity and simplicity. Futures and options only if you truly understand the risk and size appropriately. Step 3. Define your risk, not in your head, but on paper. How much can you lose and still sleep at night? Step 4. Define your triggers. What would make you add to the position? What would make you reduce it? What would make you exit completely? When you do that, the market becomes less personal. You stop getting emotional whiplash from every price swing. Now I want to address something people say a lot, that this correction was deserved. Sometimes people talk like the market is moral. The market isn't moral. The market is mechanical. Was the market stretched? Yes. Was positioning crowded? Yes. Did that make it vulnerable? Absolutely. Did that mean it had to crash? No. But in a leveraged system, vulnerability often gets exploited by events. So treat the crash as information, not as punishment. What information did we get? We learned margin rules can tighten fast when volatility spikes. We learned silver can drop in a way that forces liquidation even for people who thought they were safe. We learned gold can also have ugly days even if it rebounds quickly. We learned critical minerals policy is becoming a real theme, not just talk. We learned industrial demand pressures, especially from energy transition, are still a major undercurrent. That's a lot of signal in a short time. Here's my question for you, and I want you to answer it in the comments. Do you think this rebound is the start of the next leg up, or do you think the market is setting a trap for late buyers? And second question, if silver hits 100, what do you think happens next? Does it run higher, or does it get slammed back down? Drop your take below, because the smartest comments usually teach the whole community something valuable. Let me give you some scenarios to think about, because nobody can give you certainty, but we can think through possibilities. Scenario 1, the rebound sticks. Silver grinds higher, and we get another surge toward the previous highs as the market realizes the structural tightness didn't disappear. In that world, 100 isn't crazy. It's a psychological magnet that pulls price toward it. Scenario 2, the rebound fails. The dollar strengthens again. Risk assets wobble. Silver retests the lows as leveraged traders get shaken out a second time. In that world, you'll hear a lot of people suddenly say they always knew silver was overvalued. Scenario 3, we chop violently. Up 10%, down 8, up 9, down 7. A volatility regime where the market doesn't trend cleanly, it just punishes impatience. And here's the thing, the most likely scenario in the near term might be the messiest one, because after shock, markets often need time to find a new equilibrium, and that means whipsaws. So if your plan requires a straight line, your plan is probably wrong. What I'm watching that could change the story fast. The dollar. If it rips higher, metals can get hit again, not because they become less useful, but because flows change. Real rates. If the market starts pricing higher, real yields, it competes with assets that don't pay income. Liquidity in the futures market. Volume and open interest matter. Are rallies built on new buying or short covering? The character of the move tells you more than the headline number. Physical premiums and delivery signals. If physical stays tight while paper whips around, that's a clue something deeper is happening. Policy headlines, strategic stockpiles, export restrictions, sanctions, geopolitical flare-ups. These can hit when you least expect them, and silver reacts faster than gold sometimes because it's a smaller market. Now let's talk about what standing in this market actually feels like right now. We're standing in a market that just survived a historic washout and is bouncing hard, while investors try to decide if this is a second chance or a second trap. And that's why emotion is running so high. People don't know whether to celebrate the recovery or prepare for round 2. Here's what I know. The same conditions that create a face-ripping rally can also create a face-ripping reversal. That's not fear-mongering. That's the contract you sign when you play in a market this volatile. Don't confuse a bounce with stability. A bounce is just price reacting. Stability is when the market can absorb bad news without collapsing. We are not there yet, not even close. If you're a long-term holder, you're probably not as rattled as the traders. But even long-term holders can make dumb decisions when volatility hits. They panic, sell at the lows, or chase at the highs. The market doesn't care about your intentions. It only cares what you do today. So ask yourself a simple question. If silver drops 15% tomorrow, do you have a plan? If it jumps 15% tomorrow, do you have a plan? If the answer is, I'll figure it out when it happens, that's not a plan. That's a hope. And hope is expensive in markets like this. The bounce you're watching right now is telling you something the headlines won't say out loud. This is not a simple recovery. This is a stress test. The market just showed its hand. It revealed how fragile the structure is when leverage meets tight liquidity. It showed how fast margin rules can change. It proved that even metals with strong fundamentals can get demolished in hours when the system decides to purge. And now it's showing you that rebounds can be just as violent as crashes. All of that information is valuable if you know how to use it. So where does that leave you? It leaves you with a choice. You can chase the headline and hope you're fast enough. You can sit on the sidelines and watch. Or you can build a thoughtful position with clear rules and realistic expectations. None of those choices are wrong, but they require different mindsets. The chaser needs speed and timing. The observer needs patience and discipline. The builder needs structure and consistency. Pick your lane and stay in it, because mixing them is how people blow up accounts. Before I let you go, remember, everything we talked about here is for educational purposes. I'm sharing how I think about market structure and price action. I'm not telling you what to buy or sell. You're responsible for your own decisions. And if you need personalized advice, talk to a qualified professional who understands your specific situation. Take care of your risk, respect volatility, and don't let a chart that's moving fast convince you that gravity got canceled. If you got value from this breakdown, smash that like button and subscribe to Element Axis so you do not miss the next one. And drop a comment with your take on where silver goes from here. I'll see you in the next video.